Bitcoin is down 47% since the all-time high in October, and the sentiment was never as dark and low as right now. Retail is absolutely capitulating, and now the question comes, who's even now still buying Bitcoin? Besides me, I've never allocated so much fiat money to my Bitcoin DCA as of right now. But who else does that? First contender, Strategy. Strategy is buying more than 900 Bitcoin per day so far in 2026. They just announced today their 100th Bitcoin purchase, and they're just the one that is doing it publicly. In 2025, over 600,000 Bitcoin left from individuals. They all went to ETFs, to BlackRock, to institutions, to Bitcoin Treasury companies, to pension funds, because they know this is a Bitcoin dip and not a crash. And so Bitcoin is going down means the Bitcoin that you loved at 126,000 in October are now having a 50% discount. There's a 50 freaking percent discount on freedom tokens, as I call them. And that's why we're talking today with Michael about smart money loading up on Bitcoin, and the dumb money and the retail money also, unfortunately, is dumping it. Enjoy. What are kind of like your current sentiment where we are with the Bitcoin market?
It's easily, in my experience, I've been around the space for about 10 years, the most disorienting time. I think in just general markets, there was a chart, I don't know if you saw on Twitter, that came out. It was about the uncertainty index. And I don't even know what it's pulling, but it was effectively like almost double that it was. I don't think it was combined, but it was pulling from COVID, 9/11, 08 crisis, crash, and one other thing about just the amount of uncertainty in the markets when you think of AI and this disruption it's having across sectors, whether it's white collar work, SaaS technology firms, and how their performance, even though their earnings are appreciating, their long-term value is in question. You have gold and silver that made their rips, and then they kind of naturally have moved, back a little bit. And just yesterday, this is Friday, Thursday, the 12th, silver had like a 10% drawdown, I think, in like an hour. So it's trading like an altcoin, right? And so you have bonds that are giving you 3 to 5%, but naturally anybody with a brain knows that inflation's more than 5%. And so it's like, where's the safe haven? You have Bitcoin that's supposed to work like this hedge against debasement. And I believe it fully does on a long enough time horizon. But when you shorten the window, it doesn't, especially when most people, we forget that gold, as an example, has 5,000 years of credibility and history. And when you look at Bitcoin, it's still 17, 18 years old. And so there's still a lot of just knowledge, inertia that goes into thinking of it as a risk asset. And then you add a lot of, I think, this is a little bit on the conspiratorial side, but I think there's a lot of inorganic FUD that's out there, whether it's like the Epstein stuff, the quantum stuff. There's the Clarity Act that's kind of hanging out over the industry's head, because there's an understanding that if you get regulatory clarity in an industry, it naturally will allow for more capital to form, right? When you think about whether you're trying to build a Bitcoin company, need somebody to invest in it, investment managers are going to be much more likely to give up capital if there's a clarity that this thing is not, going to get legislated away or regulated away. So it's truly a fascinating time. I think the two other things that we talked about right before recording is like the sentiment is down. And I think the sentiment is down when it shouldn't be, in the sense that if people like stayed humble and were just, stacking, like there's a direct correlation with the amount of education you have in Bitcoin and then the uncomfortable nature of a drawdown, right? Like nobody likes seeing their wealth depreciate. But at the same time, if you're out in the world generating economic value, delivering value, you're getting paid in fiat. And now you're roughly getting twice as a number of Satoshis per dollar than you could. And so I never thought we'd be back in the 60s after what we've seen, right? There's a dislocation from the fundamentals. Like Bitcoin is 10x in fundamentals while the price is cut in half. That's just asymmetry. So you get to see that, but people got over levered, whether it's the digital asset treasury trade, whether it was taking out margin or just having shorter time horizons. And so that leads to a lot of this negative sentiment. But again, it all ties back to the meta we talked about when we started, is everyone has a very tight window gratification and what they need versus being able to take a step back and understand that this is really just a long-term perspective you need to have.
I did a tweet recently about what I think the worst possible bottom could be for Bitcoin. And of course, like nobody really knows, but if you see the drawdowns in Bitcoins, they keep getting less worse. Now, I don't know if it keeps continuing like that, but if you have the same amount of drawdown as we last did, I think from like 69K to like 16K or something like that, this would bring us to around like 25 to 30K again, which would be absurd. Being able to buy Bitcoin under 30K, like that sounds like a dream. But what do you expect for the market going forward? Because I already see the sentiment so low. It's like, can we go lower from here? But also in the next couple of months or maybe 2 years ahead, how do you see it developing?
Yeah, I mean, I caution that, famous last words is, we can't go any lower, or I don't see us going to the 30s, and then it happens. So the real thing that's not going to make anybody happy is nobody really knows. I think the thing I can share and that's worth calling out is like the objective empirical evidence of when we say 10x fundamentals, right? Like, what does that mean? Well, that means that Morgan Stanley hired a head of digital assets that's extremely sophisticated. But we see this all the time where large TradFi firms go and bring in somebody, but it's very different with Morgan Stanley. If you go and look, they're developing their own digital wallets. They're thinking about other financial services across from it. So they're going deep in. Fidelity just launched their stablecoin. We have the Genius Act that already passed. They have the Clarity Act coming. There's a reality that in the same way AI is proliferating across technology, and just like the internet is the same way stable coins, for better or worse, are being churned on. There's strategic reasons from the US administration, from the purchasing of debt, all the way to money flows. It's just a reality. The analogy is like we historically had to rely on fiber optics or copper for internet, and then Starlink changed the whole game because you go into a three-dimensional layer. Now anybody can get really fast internet speed. And what does that do? That's the same thing with stable coins. You're just moving dollars in a different plane. And so you take all of these different tailwinds, you take that we live in a world that is being understood by the smart money, whether it's sovereigns or institutions, that the debasement trade is real, that bonds are impaired, not only from a negative yielding perspective, that they're not increasing in real purchasing power, what their dividends provide, but also from a pure counterparty risk perspective, whether it was the '08 crisis or Russia seizing or China. All these different things have shown, I think this is the first year that sovereign gold holdings has exceeded Treasury holdings. So you take all of these things and you naturally have, while Bitcoin is still, 135th or 150th, whatever the number is, of gold's market cap, it still is understood by large capital allocators, like the UAE is a great example, that this is gold with wings. And why I'm breaking that down is because at a certain level, people step in, right? Like at these levels of 70K, 67, I think we're back up to close to 70, that I see it hard pressed for the price to cut in half again because of how much like demand is for this price or for this asset and where it's going, specifically with the US and the plans for it. So that's how I kind of think about it, is that I've long believed, and I still do, that we see all-time highs this year. I don't think that we're in the middle of a 4-year cycle. I think the 4-year cycle phenomenon existed, but it doesn't exist when you create an ETF that has the liquidity profile with options and futures, and now you have global demand. The dynamic just fundamentally changes, especially if we expect interest rates and just more liquidity have to come into the system.
It's so interesting, and I say that also now, and it hurts now more because gold is winning the last 12 months. Or not winning, it's like the last 12 months gold has outperformed. And so it seems like the gold people have their small a winning run, the small lap where they 15 laps in a row we won, and now there's like one lap where gold is kind of catching up a little bit again, even though it's like far behind. How do you see gold with wings, meaning Bitcoin, while gold is kind of ripping in that market?
Yeah, so I think this is I don't want to say it's a fallacy, but it's I think a misconception or misunderstanding of what is happening is insane. It really ties back to like everything's good for Bitcoin. Is I would make the case you would much rather see what's happening right now than Bitcoin going to 175 and gold staying flat at $1,800 or 2,000 an ounce. And the reason why is because if you go back to the beginning, there's very, you know, like to joke, like the Bitcoin thought leaders, right? There's a lot of thought leaders that said, well, Bitcoin has to get to 200K and then it matches gold parity, which never made any sense. And it doesn't make sense because that presumes that gold will stay static at $10 to $12,000 or $10 to $12 trillion in market cap. But then also, when you think about the amount of liquidity coming in, it starts to absorb. It's not going to all go to Bitcoin, right? It goes to real estate, it goes to bonds, it goes to gold. So you naturally have this lift. But what's crazy that's happened the past 6 to 12 months is gold doing this move. It's unprecedented, right? It's a signal that the dollar's broken. The dollar's no longer the reserve currency. We have all the things happening with BRICS nations, with China settling gold in oil and other currencies globally, that it's a sign of that gold is money now and everything else is credit. But again, to your point, you can win a couple laps on the price appreciation, but the liquidity profile of BTC is nowhere near gold, meaning that if a sovereign wants to stack tens of billions, hundreds of billions of dollars, trillions of dollars, they can't do that yet in BTC without completely moving the price away from them. So the liquidity has to go there. And so that move, the only move is gold, because again, take a step back and think about quantum. Everyone has their own lens on how serious it is. But the reality is there's very smart people that have looked at Bitcoin deeply that I think misunderstand how severe it is. They believe it's much more severe than I believe it is, meaning that in the next 2 to 5 years, there's something existential if we don't fix quantum addresses and resistance. Point being is, put yourself in those shoes, and now imagine you're a sovereign or you're an institutional allocator and you hear about quantum. What are you supposed to do there? How are you supposed to size that allocation if the hardest core people with the most education? So the point being is that the reality is it was always going to go this path, that gold was going to appreciate, and gold is going to appreciate significantly when people recognize that this thing is a neutral reserve asset. It lacks counterparty risk if you can take the delivery of the gold into your sovereign nation. But then the notion of, well, just like any innovation cycle, anything happens, you're naturally going to have the emergent challengers that will be first and early to adopt. Again, the great example is UAE versus Saudi Arabia. UAE is known as like the speedboat, and Saudi Arabia is the battleship, right? Is to contextualize how easy they can move versus the battleship. But when the battleship moves, it can take over the world, is the idea. And so the core thing to highlight there is that you will naturally have the individuals, the family offices, the sovereigns like Bhutan and El Salvador that will come in and step into these positions because they recognize the asymmetry, and that's part of the process to monetization. And then over time, as the liquidity grows and more people get conviction and confidence, the US is probably going to be a big player in this because they recognize that the majority of BTC sits in the US. You naturally can start to, gain that market share. So that's a long way of saying that I look at a positive where gold is doing this, because in the alternative, in Bitcoin goes to 175 and gold sits at 1,800. Well, the market's not counting Bitcoin as a neutral reserve asset or gold 2.0. They're counting that's telling you it's a NASDAQ higher leverage play. It's a tech stock. It's something completely different than what the market's understanding today is that, gold is money. Everything else is dollars. And in a future state, gold and Bitcoin will be understood as money and everything else is, credit.
I like that. On the quantum thing, I want to briefly note, do you think this, why do you think this quantum fight is now so present? Because most people talk about it, and it became really real for me when even Seyr talked about it in the conference calls, in the earnings call they had, I think last week, I think it was 5th of February or a couple of days ago, a week ago, made it really interesting. I was like, doesn't it make the quantum FUD really real if Seyr addresses it in the earnings call of MicroStrategy? And also, I think he mentioned that he wants to, or like that strategy wants to support the community in whatever form necessary to like get an upgrade. I mean, he also mentioned that he is of the opinion that we might not need a solution for quantum.
Yeah, I mean, I think there's two aspects to the quantum side. The easier one to digest is we are social creatures. We appeal to or adhere to social constructs, meaning that a great example is most financial institutions, they cannot say bonds are impaired, right? So like 60-40 portfolio, 60% equities, 40% bonds. We understand, me and you, that nowhere in our right mind would we park dollars into negative yielding bonds, right? Because the bonds are giving you 3 to 5% coupons, but like at the end of the day, inflation is probably 7 to 10%. That's being conservative. So you're just losing purchasing power. But the financial system's built on that lie effectively. So if you're a multi-trillion-dollar asset manager, and I know this firsthand, they cannot say that bonds are impaired. So the angle is that, well, the second that they say put on an allocation to BTC, their advisors, everyone does it, they feel the green light. So the point being is that we look to authority for the guidance here. And another great example is ESG. If you're familiar with environmental social governance, it was a whole theme about like deregulation or like a kind of carbonization around fossil fuels. And it was just a bunch of capital was destroyed. It's a very fiat thing. But point being is that came out of nowhere, and then people just started talking about it, and then people just presumed that that's a thing, and now everyone has their own strategy on like, am I doing this is very ESG friendly? So why I'm bringing that up is because once you start to bring up quantum, to Seyr's, I don't want to say credit, but like if he has institutional capital that's bringing it up, he has to address it, because if he doesn't address it and it's something that's coming up, that they're just naturally, it looks like an even bigger gap, because why not talk about it and at least, explain where his view is. The other side of it is like, I think that there's a lot of apprehension and we have to pay very close attention to what will happen or what people will start to push on the quantum side, because it's understood like quantum is very much theoretical. Like a lot of these constructs have never been implemented or like actually done before, and specifically in the way that you would need to, like, again, I'm not a quantum expert, but the understanding is to be able to even go in and back into an address from a private key, the length of time you would need to have a quantum computer running. It's a theoretical idea. And so it's important to keep these things on the radar, which my understanding is Bitcoin researchers and core developers have been looking at this for a very long time. It's a kind of a lie that this isn't something that they're paying attention to. It's just like core development has to be very deliberate. But if you get too far ahead of the skis, you start to create solutions, perceived solutions that end up being problems, right? Because now if you have these large economic actors like BlackRock, Coinbase, and others that are holding Bitcoin on behalf of others, that starts to become an attack vector in my view. And I think that's potentially where a lot of this goes, is as more capital. And that's why we focus on on-ramp, because our solution, the client doesn't necessarily hold the keys, but there's multiple institutions and they work at the direction legally on behalf of the client. And that's important because not only are the assets sitting outside of any construct like an ETF, but they're on chain, they're verifiable, and they can always have access to, if there was ever a fork, to those coins. The alternative isn't true. When people go into an ETF, they're giving up all rights on any kind of like chain that the ETF would follow. And also the idea of outside money versus inside money, because this comes up a lot around why would I just hold spot or, via hardware device or with on-ramp. And the idea is that it's kind of it's a contradictory like action where you're buying this money. Your thesis is there's too much debt, not enough dollars. It's a debasement trade. It's a hedge against inflation. But then you're parking it back into a system, right, via BlackRock that's exposed to too much debt and not enough dollars. And the counterparty risk lies not only in that construct of potential insolvency, but also in the governance rights that we're talking about, where there's like different ways that can potentially manipulate the protocol and the way it goes. So that's something I'm just paying attention to, is that you have the quantum stuff coming out, and I don't think it's going to slow down. And I think there's going to be a lot of proposals for like what needs to potentially be preempted that may not be in the best interest from like the long-term viability of Bitcoin.
I just remembered Seyr brought up that amazing quote in the earnings call, which I really liked. He said, and it's not from him, it's from some president from the US. He said, if you see 10 troubles coming down the road, you can be sure that 9 will run themselves into a ditch before they reach you, and you have to battle only with one of them. And I'm not sure if quantum will be one of them that drives itself in a ditch or actually will become a substantial problem to Bitcoin. But I just wanted to highlight that quote because I've never heard it before, and I really like it. And it's stuck in my brain since then, because I see or saw in the past, 2 years, that you worry a lot about things and then they somehow work out anyways before they even come to you, and problems kind of dissolve. But there's those 1-2 big problems where you actually have to focus on. And I'm wondering if quantum is one of that we really should and have to focus on and to make a nice solution. I'm sure we will if we have to. Or it's just something that, there's articles coming out in 2020 saying, there's articles coming out in 2020 that's saying in 2-3 years, one Bitcoin transaction will absorb the whole energy of the world. Weird things like that, and it obviously didn't do it. And there's articles coming out saying the internet is just a fad passing by. We often see problems that are not really becoming problems, I guess.
Yeah, I think we'll see a lot more. What gives me confidence and solace and understanding, in thinking about this from a mental model perspective, is that we'll see smoke way before there's fire. Right? We'll just have great incidents. We'll have a lot of things that are happening. There's this notion that the game theory around quantum development, while there's a lot of investment in AI proliferating, that everyone's going to have their own Manhattan Project for this and it'll never get leaked. And I just don't see how that happens if everyone has a global race to develop some kind of level of quantum computing, that we will, in a environment where information moves at the speed of light, that we won't naturally start to see things breaking, and specifically around just our daily environment when things start to go. Because I've had this conversation with somebody, and it's well, there's two sides of the coin of, well, would they hold on to it then to go attack something very valuable, right? So you don't get any smoke, because it's you don't want to set off any alarm bells. But then the other side of that is, if everyone's chasing it, well, to get to that level, well, wouldn't you try? You don't know how fast somebody else is getting to that end state, so you would try to extract whatever you can before that. Right. Well, the point is meaning your credentials to get into your bank account, or there's a bunch of other sensitive things. The Bitcoin blockchain is still is $1.7 trillion. It's large, but there's a lot of other ways to extract value, because you still have to back into that private key, and there's no telling how much energy and time that would take and cost. Versus, are there other lower hanging fruit? And that's kind of that smoke. You'll just have weird things happen you won't be able to acknowledge or understand, and then people will see that this is coming further and further out. It's a crazy time, because the other side of it is energy weapons, if you're familiar, and there's an idea of all these things that are conspiratorial are starting to come to be true. A lot of it was in these Epstein leaks, but even in directed energy weapons. And then recently with the is it Venezuela, that we went in and there were the guards were saying that there was weird sounds and smells, and they got debilitated, and they dropped to the ground, and whoever went in, the Navy SEALs were or whatever, the military apparatus went in, and they were able to pull Maduro out with no casualties on the US side. But point being is the notion of directed energy weapons and all these other different things that have been known as taboo, they exist. And that's a lot of smoke, because you can go find out a lot about a lot of this. People have understood it. So the notion of quantum getting into any level that could hack a private key, I think we will learn way before that these things are starting to actually become more realistic and relevant.
The first thing that every Bitcoiner does, and the most important activity that every Bitcoiner keeps on doing, is buying Bitcoin. And I personally use Relai to buy and sometimes also spend or sell my Bitcoin. And there are two main reasons why I do so. The first one is it's Bitcoin only. They do not do any shit coins. They do not do any cryptos, any stocks, or anything else. This is a tool, an app that is fully focused only and solely on Bitcoin. The second one is self-custody. They give you the keys to your Bitcoin the moment you buy them. You never give them the control over your Bitcoin, and you don't have to trust them because you can verify that you and only you have the keys to your Bitcoin. There's no third-party risk. There's no freezing of your assets. There's no rug pulling. There's nothing of that. Download Relai, the app, on your phone, or go to relay.app on your browser and use code Robin to save fees and get cheaper Bitcoin. I want to tell you about something very special to me. It's called Microseed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today, and you can make with that unlimited amount of backups. Go now to microseed.io. What do you think about the Epstein file that's he's Satoshi Nakamoto?
I mean, I definitely don't think he's Satoshi Nakamoto. I think, honestly, like I would flip it. I would say it'd be wild if Epstein and that group were not talking about Bitcoin back in 2011, 12, 13, 14, because if Bitcoin is that radical of a disruption, needing no intermediary to transfer value, and they weren't actually interested or trying to get involved and see how they can participate, then it'd be very odd that they weren't. So I think it makes sense. I do think that it probably, I haven't, again, with time and their rabbit holes, I haven't gone deep into them, but I see the stuff that, everyone sees on Twitter. I do think that it does give a strong signal of who to watch out for from your counterparties, partners, where you take capital from, because there is actors out there that either want to undermine institutions, undermine the actions or long-term missions of projects. And I do think that there's something to the investments on behalf of some parties that were involved, that have been involved in Bitcoin forever, that have, flown out to meet him on various islands. And then their actions, my instincts tell me that if you go and back into capital that was brought in, and then some of their actions long-term for Bitcoin, they may not actually be congruent with the long-term viability of, Bitcoin being decentralized is a great example, small blocks versus big blocks. But yeah, I think there's a lot more. I'm happy to go deeper. I think a little bit about these files and like what their end state is or why, but at least as it relates to Bitcoin, I think I don't see any relevance to the fingerprint or footprint on being able to steer or manipulate like an open source protocol that is Bitcoin today in 2026.
I mean, it's interesting because obviously nobody is the head of Bitcoin. And so naturally, people of authority that come in touch with Bitcoin will get attached to the name of Bitcoin. We had the whole thing of like, oh, it's Trump coin. Like the Bitcoin is going up because of Trump and Bitcoin is going down of Trump. Because this was especially in the beginning of the election. Now the Epstein files come out and everyone is saying like, oh, like it's a pedo coin. It's like how? And then it was like previously Elon Musk also in 2021, if you remember, when he kind of had his face in Bitcoin, and it's just in multiple cycles. There's always like those figureheads that are either very well known or some kind of authority in some other space, and then they mix themselves into this Bitcoin ecosystem, and Bitcoin attaches. They attach themselves to Bitcoin at that point, and I think this just this just has to happen more and more for people to realize, oh, it's not Epstein coin, it's not Trump coin, it's not Elon Musk coin, it's not that and that coin, it's just Bitcoin. And nobody is at the head of that. There's no authority on that. And I think people really struggle with that there's no head. They really want to have a head and just fight that head because they cannot fight the coin itself.
Yeah, I agree. I think there's no dollar, there's no Trump dollar or, MSB dollar or whoever. So it's just money. It's like the same thing as a car. I don't even know how true this is, but it's a good analogy of when the car first came out, it was bank robbers that were using it, right? Like when any new disruptive technology comes out, I mean, I think this is objectively and empirically true, is web traffic when the internet first came out was used for pornography and then illicit activities. It's like you have a new construct, you have people on the edges trying to utilize it for different things. And so it makes complete sense that shady actors were very interested in Bitcoin in its early days because you can move money with no intermediary, right? That's just objectively true. I will say though that we're fascinating creatures that we need to latch ourselves onto narratives. I think probably one of the biggest, there's two big things that have sentiment way down. One of them, and a good buddy, and he's talked about this, I think on other pods and also ours, Matt Odell, he's referencing for the first time in a Bitcoin, bull market, we've seen this fracturing around a culture, right? Because before everyone was in it together as the Bitcoin price rose. And so you're all in it together when the price, goes against you. But in this new run up, you had this fracturing of a lot of influencers that effectively kind of sold their soul to go to these digital asset treasury companies, and they're all underwater, and a bunch of people have lost their complete shirts in that trade. And so maybe some people made out okay, maybe others didn't, but you just have these different sentiments. And then it's also different levels of reflexivity, because how much, look at what BTC is down 40-45%. You look at some of these DATs, they're down 99.9%. It's a different level of pain. So I think that's one side. The other side is there's no real catalyst or point on Bitcoin's downward trend right now. And so to your point about looking at Epstein or quantum, it fills that gap in our brain that itches on, I need to understand why. Because if I don't, I think the subconscious level is does this thing not work? Is the value prop not there? That's why Bitcoin podcasts are such a big thing. Is because people need to reaffirm that their position is right, because this whole notion of money, there's a new form of money that doesn't exist. You can't touch it. It's such a radical thought that the podcasts serve as great and very important, and specifically also education and research, because naturally there's very few people that people can talk about with this stuff. And so they have to go out and listen. And this is kind of part of my journey back in 17 is listening to a lot of, there was only a few Bitcoin only podcasts, because you need to know that you're not crazy. And so part of going crazy in sentiment is if the price drops 50% and everything looks positive, from the legislation to the Genius Act, to Trump being the president, to making money, to all the, different financial institutions embedding Bitcoin services into their platforms, but the price still corrects. That's where you have to start calling out, is it Epstein? Is it quantum? Is it X, Y, or Z? When in reality there's more sellers than buyers at the current moment. But the thesis still remains the same, is that there's too much debt, not enough dollars. And in a world that is increasingly becoming more chaotic, there is a premium that most people do not hold, in that Bitcoin can be held in a way that removes counterparty risk. Because that's the thing that's still widely misunderstood and mispriced, is that if you're holding real estate, you're exposed to wherever the real estate is. So we saw this, and most people are like, well, why would I care? And it's like, well, look at COVID. Think about the craziness that happened with COVID, because right before COVID, there was what happened in Hong Kong and the riots, and a lot of people fled and left. And so any real estate that was there is potentially impaired. If you look at San Francisco as another example with COVID and the amount of craziness that happened, now it's obviously turned around. But if you have a real estate portfolio in these different segments, and then you can take that to every other asset, whether it's your equity, you can never really custody it. You have overinflated multiples on the value of a business, right? Because of the way that we have too many dollars. Bonds are obviously, the dollars aren't yours, your bank account, it's an IOU, you have up to 250,000. There's only so many places to park capital. And there's very few that relieve counterparty risk, meaning that you can wake up tomorrow and not get rugged by whether it's the geopolitical situation or your bank account just shutting you down. And so that's something that's still widely mispriced and understood and appreciated by the market, is that you can just take delivery of that BTC and nobody can ever take it from you. So the price can cut down 50%, but it's still the same number of Bitcoin. Versus in people experience this in a bunch of countries, but I know you have a lot of Western listeners, and we're based in the West, and like we still don't fully appreciate that a bank can just shut down over the weekend and your money is all potentially gone.
It's so interesting. And when I think about, you mentioned in the beginning, and actually I think I want to show this to people because it's a really interesting development with the strategy and treasury companies, because they do move very differently. I mean, not very differently, but in a very amplified way. If we look here at Bitcoin, we actually up today, I think 4% or so. So the last 1 year is down 28%. And if you look at the last 1 year at strategy, we're down like 59%. So about double, a little bit more than double actually, we're down. So today it's an up day. Strategy is up 8% today, and Bitcoin is up like 4% today. So there's some amplification going on, that's for sure. And it just like moves, not asynchronous, but it definitely moves differently. Now, strategy is a different beast than every other treasury company, I would say. And then there's others that have not fallen 60%, but 90% or like 95% or 80% and all of those things. But it is an interesting observation, not just from the price perspective, but just for generally, it seems to be there's like Bitcoin and the self-custody crowd and being hard on like the sovereign values of Bitcoin, and then there's treasury companies, the DATs or the digital asset treasury companies, or the Bitcoin. I mean, Bitcoin treasury companies is like PTC, so it's kind of confusing to call Bitcoin treasury companies PTC. But it seems like there's like some kind of like fractioning of the community. I mean, there's always kind of fractioning going on, like a lot of different categories, but this seems to be a bigger fractioning than the other ones.
Yeah, and I think like it sometimes comes as a pejorative to say like there's a sovereign usage, or a lot of times there's ideologic, like that's part of where I've always try to set in the middle, is understanding, I joke and call it like there's the right side of the camp, which is the crypto TradFi folks. And it's like they read the forward to the Bitcoin standard. They never opened up the book. And those are the people that are playing with altcoins and leveraging multi-party computation tech. And they're doing all these weird things that they just don't fundamentally understand that this is a money game and these things are competing with money, and money is a winner take all. There's the other side, which is the side that I come from, which is, to your point, the ideological sovereign, the person that believes that you should have, in some respect, some level of self-custody, because that's pure optionality. That's what money ultimately is for optionality into the future, in an uncertain future. But there's a core idea that like the majority of the world is not, from a technical perspective, able to hold a UTXO, but then really, even more importantly, even if you could self-custody and everyone could, from a socioeconomic perspective, from things that people would be willing to do, most people don't want to be their own bank. They don't want to have their family kidnapped. They don't want to have, it just came out this morning that the Binance CEO of France was like, I think they broke into his house. And so point being is there's a bridge, and that's what kind of like we focus on with what we build, is you get the assurance of the self-custody without actually having to manage those keys. You can travel and not have to worry about it. But where I'm going out is with, I don't necessarily think the fracturing on digital asset treasury companies has anything to do with like sovereignty per se, because that is an easy like cop out, not for you, but just in the market of like, oh, these people are Luddites, they don't get it. It's just about the actual fundamentals of what you're holding versus, like, you, to the point of MicroStrategy, whether it's up or down, you can't eat your MicroStrategy. So the price, like your gold or your Bitcoin, you can quote unquote, like, you can't actually eat it, but you can, in the sense that it's a liquid market that somebody in your local area will take it for food, will take it for dollars and transfer it. Most people aren't taking your MicroStrategy stock, especially as the price is falling. So you take that's that level of counterparty risk we're talking about. But then you just take the exact notion. There's a lot of fallacies built into like crazy stuff around institutions because they can't handle the volatility. And if you just bake into that, it's like, well, then just tell the institution to go buy a money market fund or some other instrument that they're comfortable with that gives them their 5 to 8% coupon, and then just buy less Bitcoin. And they don't have to self-custody it. They can leave it with us. They can put it in an ETF, but you can still blend into what you're getting without the counterparty risk of some other third party that has multiple levels of counterparty risk because they're giving it to Coinbase. Like, this isn't explained because everyone got bought. And so where I'm also getting at is that Vijay Boyapati was on our pod, and he has a real great example. Is like, if you want leverage, right? Because that's the idea. If you're buying a DAT, it's because you think you're going to make more Bitcoin. Nobody else would do it. They just think it's going to go up. Then the rational thing to do, if that's your stance, is just to take out a loan against your Bitcoin and buy a little more because you have all the execution. You don't have to deal with any of the counterparty risk. We obviously know that's not a smart move, right? Because like the price cuts in half and you don't know what you're doing. You got to have enough collateral or dollars to pay it off. But you see where I'm going with it? Is like, if you want to execute on that trade, then that's the way. And I've been saying this since the very beginning. And I'll pull this up because, you know, this is just, again, objective, empirical, that DATs, this was at the low, right? So 60K. I don't know if you can pull up the screen or if you see it, but it's effectively, there was digital asset treasury companies are down $25 billion cumulatively, and with zero above their cost basis. So this has moved a little bit, right? Because this was at like $61 or $2,000. So the price is up. So let's call it, you know, they're down 22 billion cumulatively, with probably most are not above their cost basis. And so the last thing I'll say on all of this is these things don't have fundamentals. Like, there's no reason, like when you look at a construct of the notion of a closed-end fund. So a closed-end fund, you're allocating whether it's gold to a hedge fund or it's a Bitcoin spot fund, right? Like the ETFs are closed-end funds, and they trade at some discount than the net asset value because you have management fees, you have the things associated with operating that. So there's no reason why these products should trade at a premium to the net asset value. So there's all these theoretical things that were brought up, whether it's Bitcoin per share, which I like to say Bitcoin per share is like casino hour per share. It's like, how much money were you up at the casino, right? People will say I'm up. But then when you go home, you end up with like a hangover and very little money, if no money, right? Very few people walk out of the casino. So you end up, so they've even people have tried to mess around with the Bitcoin per share kind of thing. But point being is, so you start to layer on all these value props into this solution. And when the trade goes against you right now with the 25 billion in cumulative loss, zero cost basis or none above their cost basis, and to your point, some being down 99%. When you were sold by somebody that this is better Bitcoin, you can make more Bitcoin, whatever it is, there's no fundamentals that you can anchor yourself to. Like we talked about the 10x of Bitcoin's value, the 10x in the plumbing that's happened in TradFi, the amount of engineering work on, Lightning Network, all of these things. There's nothing fundamental outside of, well, this was supposed to go up higher than the Bitcoin price. And so you puke out that position, because if you watch the asset go from, 99% down, what are you supposed to do from an investment perspective, right? Like that reflexivity, that amplification hits you even harder, because there's one thing to hold Bitcoin and already have to deal with that volatility. There's another thing to hold this like theoretical, because these things are theoretical. Like this is the first wave of them. And I make the case that MicroStrategy has the immaculate conception similar to Bitcoin, where Bitcoin, you can only do it once, and MicroStrategy was the first. They have this first mover from the liquidity and potentially, accessing the debt markets, so that they'll be okay and could theoretically have some premium on their BTC. I think long term, I question that for a number of other reasons, but hopefully that gives you a lens of how I think about it, because I know you probably have some MSTR, and a lot of folks do, and that's fine, but I don't think that these things were explained or talked about in the way that people should really underwrite them, especially when the vast majority of the world doesn't even understand Bitcoin. And so now you have to layer on some other thing on top of it. It has nothing to do with ideology or sovereignty. It has to do with just fundamental, like timeless wisdom and prudence of, you buy the thing, you sit on your hands, and you park it in a way that reduces counterparty risk.
Yeah, I was for a very long time very against strategy. I had Seyr on my podcast. I was at this 100K party, and still own zero strategy stocks. I bought strategy probably a month ago the first time, or 2 months ago the first time. It's like, yeah, I think like middle of December and January, I bought the first couple of shares. Really not a lot. Just I want to get educated on that stock, and because I was really never deep into that stock, I never really researched it. And I think the best way of researching a thing is owning it, because then you're incentivized to actually research it. And for me, it was like, okay, too many people tell me about strategy, so I have to research it and I have to kind of make up my mind. I'm not finished yet. Like I try to go deep and slow. And the only thing that I find fascinating till now is stretch. Without stretch, I would not be that interested in it at all, and might already be out of it again. But stretch is a very fascinating kind of product, and I say that because every person outside of Bitcoin that I tell about stretch is like, oh, how can I invest in it? They are very cautious with Bitcoin, but they're very quick to invest in stretch. And I was fascinated by that. And now we also see, even in the bear market, even when Bitcoin is down, stretch is still at par, and they even trade a little bit above par sometimes, which means they can launch the ATMs and just like buy some Bitcoin. I'm not an expert at all in those topics, so I miss a lot of nuance there because I'm just not coming from a TradFi background. So I literally have to learn all the things that strategy is doing from the ground up the last 2 months. That's why I'm taking my time with it, because I just don't understand what's going on with stocks and TradFi and all of those things. But stretch is the first thing that strategy did that I find interesting enough to research deep into the stock. The other thing is like the convertible notes and like that didn't really interest me.
Yeah, I think that's super fair. I mean, to be honest, I won't, but I probably should. Luke Groman, we had recorded with him, and he had this really interesting take because you hear a lot of money managers that refuse to acknowledge Bitcoin as a potential viable just asset to invest in. And you always know the sign of real intelligence when somebody's able to be open-minded, either in changing their positions or just like what you did was have some allocation, because then you can start to learn more about it. So Luke, I think he says in 2013 or 14, he bought a little bit because he just wanted to know how it works. And that always left the door open to, well, like, what is this thing? Which was very valuable because he understood this asset, and he's not only invested, but he made some great calls because I think he got out at the top. But the point being is, I think that's smart. My question, because I'm genuinely curious, is after doing your research, there's like two parts to the question. Like, one is like, what's your just overall take? But the other one I want to ask, like, just in like what you found about strategy. But the other one I want to ask is, why is it a better product for you to park? Let's say it's 10% for easy math, and right now you can get like 5. Let's call it, whether it's 10 or 11. But let's just say it's 10 and you can get 5% interest on your dollars via like money markets. Is pretty low risk, right? From either treasuries or through the financial system, get 5%. And yes, 10's better than 5. But every month you took that 5% and you purchased it in Bitcoin. So you hold on to your principal, and then you have BTC. Isn't that a better product than 11%?
I mean, with the 11%, you can also go ahead and buy Bitcoin. Or,
yeah. Well, but it presumes, how long can that 11% exist in perpetuity, and how much risk lies into that is the point. That's the thing that I think that's the thing I think gets discounted with a lot of these things, is that they're fundamentally new, independent of Seyr and strategy. There's just this realization, anybody that's been around long enough, that outside of buying Bitcoin and holding it, everything else gets really dicey when you talk about counterparties, right? So you can go back from Mt. Gox, the most recent that a lot of people probably don't remember because they weren't around or weren't heavily invested, was like Celsius, BlockFi, Genesis, FTX. These were all new constructs of, okay, I'm going to let you use margin, I'm going to let you take out a loan, I'm going to give you interest on your capital. They all promise some more money. And I'm not saying this is going to happen there, but it's just in general with a new asset, it's the Wild West that the first movers have never really like made it out the gate or to live. And so I just always anchor to, again, this is more instinctual without doing the research, is there's no such thing as a free lunch. And that it may work for a while, but long term, and then there's obviously the having to think about it, because there's a mental analysis where you're not really parking serious capital there. It's for your research. But if you are parking serious capital there, you're watching that thing like a hawk, because you're trying to worry about what's his liquidation price. He's throwing out numbers like 8K or whatever, but you're just like looking at all of this versus there's a zen, as you know, in having an allocation to a money that can be seized. And then you can go work on your craft, like this podcast and other things that I think still discounts that these things are investments, not savings, where I'd make the case that your dollars are somewhat of savings, even though they're being debased, but then you're sweeping it into your savings, which is BTC. And even if you're marginally, it's the notion of nominally you're getting more yield, risk adjusted, you're getting more yield in the former versus the latter, meaning holding your dollars with the US backing, treasuries, and then you get that Bitcoin, you can sweep it to your hardware wallet versus whatever the hell and how long that's going to exist in perpetuity.
The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They are also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together. I mean, there's a lot of thoughts actually from my side. I think, first of all, before you study strategy, you should study real hard Bitcoin. So you should understand Bitcoin on a very high level, on a very good level, on a very deep level, I should say, before you even look at strategy. Because strategy is Bitcoin plus a whole other things. And you should realize that strategy has none of the properties of Bitcoin. Like, it's a very different thing. I think there's a lot of people who say like, oh, I'll just buy Bitcoin and some strategy and that's just amplified Bitcoin. No, it's not. It's a stock. It's a security. It comes with risks. The management team can, even if the idea and the model is good that they are executing, maybe the management team goes rogue. Maybe Seyr is going somewhere else, and then there's another CEO coming in. Like, I see he's not the CEO, Fong Li is, but like there is just a risk of a security of a stock. And I think Seyr actually made a 1-hour video with a podcast back in the day where he lists all the risks associated with a security. I think they made a series with like risk on real estate, risk on securities like stocks and all of that. And you can go ahead and download the 10K, the 10Q reports, and you can see, because there they have to list all the risks to the business, and just read that. There's a lot of risks to strategy to all those products that are not there with Bitcoin. So that's a really good point. And I think people should be aware of that. And I would never allocate more than 20%. Like 20% is like a very hard limit. Now I'm more like 1%. So it's very far down that limit. But then the next thing is, you have to ask yourself the question, why would you even do that? Like, why would you even go ahead and invest in strategy? You would only do that if you think you can outperform Bitcoin with that, and you would only do that if you are keeping up to date with strategy, because you are no longer a saver, you're an investor. And if you're an investor, you have to keep up with the news, you have to keep up with the management team, you have to keep up with all the things they are doing, and if it's going in the right direction, and if the theory is actually working out. It's fascinating for me that Bitcoin podcasts exist, because frankly, we would not need to check in on Bitcoin. It's like we could just buy it, explain it, and like hold on to it. With strategy, you cannot do this. There things can change from one month to another month, and you have to keep tabs on it, because it's a security, it's a management, it's a company. And when we learn something from history, companies always fail after some time. Like they go up and down. The 10 most valuable companies right now didn't even exist most of the times 20, 30 years ago. And so I would just urge people to really treat Bitcoin and strategy very differently.
Yeah, those are all really great points. I think the last one is really widely underappreciated, but it gets into the long term, where I look at this as a renaissance philosophically around, once people realize, to your point, that this is savings, then their mental bandwidth opens up, because you're not worried about how I have to follow. And then ultimately, depending on what your exposure is, you have a taxable event when you have to sell to get into Bitcoin, and do you end up with actually more Bitcoin? But the other thing that we didn't even discuss, and it's the biggest thing, honestly, but we always forget, because again, we go back to those social constructs of appealing to authority, that the custody issue is the number one thing. The whole thesis goes away if his third-party custodian loses the money. So there's lots of levers there. There's one that it's just pure insanity and questions their intentions long term, that you have $50 billion, your whole thesis, your whole life's work, everything he talks about, and he can't invest. It doesn't cost much to roll and build your own custody for that level, where you can have eyes on those keys and distribute and all those things. And we've learned, right, nobody in their right mind that follows the base that has majority of their net worth, right, 20 to 80% to 100, would leave it on a third-party custodian, because they don't even have to go, belly up. They don't have to have a hack. They don't have to have an insolvency. Your phone can be manipulated between your phone servers and theirs, or they could just say, hey, we don't like you. You're sitting in this country. You're sitting in this state. This is what's happened to like early days, where from money transmission, Coinbase didn't operate in certain markets that they were once operating. They just had to close down accounts and not let people get money out of those states. And so that is the underlying premise that gets widely misunderstood, because again, we're still early and there's a lot of unsophisticated people, rightfully so, because they have their lives to work on, to focus on, that there is just a custody problem, that if there's a single point of failure, there will be a single point of failure on a long enough time horizon. Private keys are just data. Everyone understands that data is leaked every day, all day long, across all sectors. And so for the angle of this thesis all has to play out, but they're not concerned with the third-party custodian, when historically the only custodian that has the longest track record is Coinbase. And you can make the case that their increased success actually increases the likelihood of non-success or having a cataclysmic event, because it's a larger honeypot, it's a larger ROI. And so when you think about social engineering, Bybit was a great example, where North Koreans embedded themselves into Bybit, and that's how they kind of manipulated the smart contract with the Ethereum. It was like $1.2 billion in losses. That even if it's a 10-year game, there's all these different angles that Coinbase could not fulfill their obligations. And so that's the thing that, like, I think most people, if they understood that, would rethink and re-question a lot of the assumptions when it comes to the digital asset trade, which is ultimately where's the underlying sitting. Because if one day one of those firms go belly up, it's not only just that firm that had their custody exposure at the custodian, it's almost all of them, because everyone's going to question, wait, are you exposed? Right. And so these are just, again, fundamental things that on a long enough time horizon. And that's why, like, our firm, we work with digital asset treasury companies that understand you want transparency, you want market sentiment and confidence to be in the equation. Because if the thesis is somewhat right and DATs will accrue some premium, Well, at a minimum, you should let your investors not have to bake in the assumption that the underlying custodian is at risk, because that will happen. I witnessed this in 22 when BlockFi, Celsius, and FTX, when insolvent, the amount of assets that went into my previous firm was the majority of them, because that's when everyone starts to question, well, holy crap, like, who's my counterparty? Where's the asset sit?
This is a really good point, because we're not used as humans to have that question. Like, like if it's just stocks and dollars and euros and all sorts of instruments that are don't have a final settlement, that is like not a physical asset, not actually physical, but like, you know what I mean, the physical layer that Bitcoin settles on, you have a custodian risk. It's like gold or something else, even better than gold or worse than gold, depending on how you look at it. It can be stolen. Like you no longer need to break into in the huge vault and like jump over hoops and kill bodyguards and all of that to steal some gold. You can do it from a laptop to steal Bitcoin. Like it increases the attack surface for each and every one that holds Bitcoin massively. And so the custodian question with treasury companies is a really interesting one, because you are just staring there and thinking, okay, they have 700 whatever Bitcoin or 700,000 whatever Bitcoin. How are they making sure they're not losing 100,000 of them just in a custodian failure? Because I don't think they will just get it back. I don't know how they set up the contracts, like how they custody all of that. But it is a huge risk you have to consider, I guess, with digital asset treasuries.
It's the risk you have to consider in all of Bitcoin. I'll make the case that this is why Bitcoin is still at $1.6 trillion and sits at 70,000, whatever it is today, is the fundamental custody problem. Because the same thing you mentioned on the digital asset treasury company and single custodian exists in self-custody. People just aren't aware of it yet or haven't been presented with solutions. Because at the end of the day, if the asset monetizes to the level we want it to, then all that is going to happen is more and more bad actors in the physical and digital world, to your point, all over the world can try to access Coinbase. So it's not all the, like, you have to, go in with helicopters and armed guards and all the things to seize the gold, which actually happened recently in a Canadian mint that was in Africa. But you have the physical layers as well. And this is why we focus on what we do at OnRamp and around this, is that there's a market structure problem, because the idea is that Bitcoin has such great product market fit, right? Like the idea that people need it. People need a store of value, that it got to roughly $2 trillion at its peak, with no one ever credibly being able to say tomorrow it'll be there with 100% certainty. Because even if it's in self-custody and you have your backups, if you get hit by a bus, and let's say the other person you told, right? Like there's that problem, but there's also the problem that wherever your backups and however it's secured are open to somebody else finding it. And so, sure, like we did it, but the reality is that's why most people do not come into this space or allocate. Everyone has experience listening, you and I, that we've probably orange pilled or gotten somebody, either very few or no one, because I started to reflect and realize that when you start to explain Bitcoin to somebody, they shut down, because at the very meta level is you're ultimately giving them a problem, not a solution, because you're telling them, oh, there's this thing, but now they have to go figure out, well, how do I make sure it doesn't end up in North Korean wallets or in a UK landfill? Because that's all their perception is. It's not that Bitcoin fails. It's that all these different third parties fail, whether it's the hardware device or that. And so until that's solved for, then it becomes very risky for anybody to park any material wealth there, including institutions. And so that's why we focus on what we focus on, because there is just a longer term view of, if you want real capital to come in, you have to make it as simple as the analogy I use is like we ship MacBooks, because pre a computer or PC, everyone, and it mirrors very similar. You think about the Bitcoin community. I'm sure you go to meetups or have gone to meetups, is everyone has their own version of how they roll their custody, their counterparties, what's the right view. And this existed in the 70s when you would go to a meetup and somebody would say, all right, I have this hard drive, I have this RAM, I agree on this like motherboard. And that works for a hobbyist space, but eventually, the market structure comes out and people recognize, well, there's less people interested in like the inner workings and mechanics of this, but they just need it. And so you develop a personal computer, and whether it's Gates or Jobs, and you ship the thing and people get the value, they open it and they get to go back to their lives, but they get an insane amount of value from that tool. And so when I think about like multi-institutional, what we do is we've gotten it down. It's funny that we're recording this week because we put a whole blog post out about how you can take that wallet configuration, you can view it audibly on chain. And so you can always see the balance. But when we took what used to take us 2 to 8 weeks in shipping devices and multi-sig to 2 to 8 minutes. And so that's that angle of anybody on the planet Earth can get the same level of custody. Our largest clients have over $250 million with us. That same level, we work with pensions, family offices, but individuals can click a couple buttons, get through, and have that same architecture. And that's what I get excited about, because I think everyone listening wants more people to hold Bitcoin. But the problem is that they have to think about all these things when in reality, there needs to be products where they just know they work. A MacBook, it gets shipped, there's no viruses, and I get access to the World Wide Web. In this world, you get access to the best savings technology that's ever existed.
That's one hell of an amazing comparison. I love that, the MacBook analogy, because people are even confused with RAM. I just my sister just bought a new MacBook and she changed from Windows to Mac, which great thing. I think nobody should be on Windows. That's a whole nother discussion. And she had all those questions of like which MacBook and which RAM size and like what kind of like thing do I need. So MacBook is super easy, and for a new person it's still complicated. Like my first computer, I assembled everything myself. Like I literally searched for all the elements and then got it shipped to my house and built it myself. Obviously, I had to change out things because I realized, oh, this doesn't work with that and I need that. And all of a sudden, oh shit, in that thing that I bought is not enough space for that. And so like there are a lot of like weird things that happen with that. And so now I'm just going in there like, oh yeah, I need a MacBook Pro, that, bam, bam. It takes me 2 minutes to decide which MacBook I want. Like it's very easy.
It's fascinating you say that, because I think that is really a great example of, we kind of do ourselves a disservice. I truly believe this in the sense that there's folks that come on your podcast and that are our friends that will tout that self-custody is the only way. And it's obvious in the same way that but it's funny because nobody would ever say self-custody for your cash or gold is the only way. Like nobody in their right mind would park all their gold if all their wealth was in their gold in their house, because the rational thing for people to do once they found out about that would be to go and seize it. It's the same thing with like Citadel theory is if somebody holds 1,000 Bitcoin and creates a Citadel, well, a bigger Citadel is going to come, militia is going to come take it. Like you need, logic of violence. You need to create like market structure. But the point in sharing that is, imagine in the world where you develop the computer, everyone that needs access to the internet has to do that. So you have this squared problem, right? Like Metcalfe's law, because before you can even get access to the internet, you'd have to develop and go through that process. So people will do it, but you will only have so many people doing it. And then the X squared is limited based on the number of people willing to do that. So think about how much value you've gotten from people online that have never done that could never do that, right? And so it's the same thing with Bitcoin and self-custody. Is there's a lot of people that have the fundamentals and understand Bitcoin and would say never go and park it in a DAT or rehypothecate it. They have all of it, but then they missed the last step of forgetting how hard it was and daunting it was to park all of their wealth in 12 words, right? And so that's that barrier that we look to like solve and gap for. And we work with early entrants all the way to OGs, because as you go down that like rabbit hole and people holding $250 million, you realize, oh God, like I don't want my family to die for a trade. I don't want to get hit by a bus. Like it becomes really real and tangible and you can't mess it up. And so I think that the analogy there is that you want more people to adopt this, because from an altruistic perspective, everyone benefits if they can preserve their wealth. But from a pure capitalistic perspective, you want more capital to come into the space, because in the same way that, the Squared and the amount of people online help and benefit you, more capital coming into Bitcoin also helps you. And so I think like that's one of the biggest gaps we're just early, but there's that infighting on like what makes the most sense. It's realistically, what makes the most sense is to objectively explain the trade-offs. And there's extreme trade-offs across the board. Putting all your money in self-custody has trade-offs, putting all your money in third-party custodian has trade-offs, putting all your money in multi-institution custody has trade-offs. We look at it and say that has the least amount of trade-offs for the vast majority of people. And that's kind of why we focus there. But like me personally and a lot of our clients, we do a barbell approach where we'll have a version in self-custody. It's the same way you carry cash in your wallet or at your house, because you always need that. But then the realistic nature is you don't want all of it inside or accessible to you, because then it's not even you that's at risk, it's your family members. Because somebody takes somebody's family member, right? And then they know that their person that loves them has access to this vast amount of wealth that historically hasn't existed, because nobody kidnaps Jeff Bezos' cousin or whatever and says, Jeff, send us $1 billion in Amazon, like liquidate that stock. Because by the time they sell the stock, go through the financial system, have to go and get the duffel bag, that person's already caught. There's no reason to do that. But in Bitcoin, all this money sits so close to us, whether it's one click of Coinbase or in our wallet. But again, this is just why we're so early and why there's an opportunity, because the price is 68,000, because most people, they know these things exist. They just don't know exactly how we've talked about them. So they don't know how to identify where the gaps are and then how to make sure that they don't end up in one of those gaps.
Yeah, I think this is very wise. And it's like, I love also the barbell approach, especially for someone like me that has income in Bitcoin. I think, I don't know how much exactly, but around half of my income is now in Bitcoin. And so I need access to that on the mobile when I go and travel, like to conferences or whatever. But I also don't want to have huge amounts of wealth on me. Like I don't want to walk around with like 50 grand of Bitcoin just being on my person, because this makes me a target. And so having some kind of mobile wallet or something like that you can just access from the mobile super easily, but you never have a lot there. It's kind of just your wallet. Money comes in, money goes out, and you can access that. And if there's more in there, you just put it in your vault that is safe and is there, and it's like has all the measurements. However, this is designed, and you cannot access that right away. It's like multi-institutional, multi-signature, whatever you choose to do. This is, I think, a very good approach, because you get the best of both worlds. You have it accessible right now and here, but also most of it, like 80%, 90%, 95, 99, whatever the number is, depends on the person and the situation, is safe and is not accessible when someone comes to you and says like, hey, I want all your Bitcoin. And you're like, yeah, this is the process, and you most likely will never get it. It's like, and it takes a while, and like whatever the thing is. Oh, and we have to fly to Mexico. I don't recommend that, but so it's kind of this two ways, and you can even make three ways process where you have something accessible, so you can use Bitcoin actually as money, especially for someone like me that actually earns in Bitcoin and has to interact with all the apps and has to make it easy on the phone, but then also have most of it where you just cannot access it quickly.
Yeah, it's exactly right. I mean, these products, I think we talked about it on the last pod, but my background was coming into space, needing to figure out custody, and then onboarding billions of dollars, thousands of clients to multi-sig solutions like collaborative custody, to your point. And I kept running into the issue personally where if I traveled, even if I had like a little bit of the cash, you're saying that there's a reality that I left everything at home. However convoluted or crazy the construct is, if you're familiar, you probably, being around the space, you have multi-sig set up, whether you roll your own or work with somebody, you have multiple seed phrases, hardware devices, wallet configurations to reconstitute. That data has to live in disparate places, because if it lives in a centralized place and the house burns down, you just killed the whole value prop of why. So now you have it everywhere. But the other side of that is complexity is the enemy of security. So now you have all these places that somebody can start to put the pieces together, because you can take a picture of a seed phrase and then one piece you can, because most people put a config file, which is okay, like in a password manager. But if you get access to that, now you have the second piece. So do you take all of that with you? Well, that's not rational, because you go across, I go to the UAE or whatever. So I don't take it with me, but now it's at my house. And then my wife's doing, something with the cabinets and people are installing. So now you're worried about, okay, who's in your house? But then if you take it with you, you have your other problem. But then independent of if you only had some walking around money on your wallet, what happens if you're there and you need 10% of it or 15% or 25 because you want to buy, like whatever case you need to access that? You have to go back home. So the way we set this up is you have these wallets that are easier to access or long-term cold stored, where some clients will like lock it for 365 days. So the assets can never move from the vault unless they come and fly to meet us specifically, because a lot of Bitcoin holders don't. So there's a lot of flexibility. I think the Nick Szabo had some really good quotes on this, if anybody's interested, recently, talking about just we are so early in Bitcoin that we will look at Coinbase as a blip in centralized custody, because for the first 15 years, self-custody and third-party custody were the only things. But imagine Bitcoin at $1 million. We will laugh at that. We let Coinbase hold that amount of assets, but also that we held that much Bitcoin in our person, because when that price rises, that's a proxy for awareness. That means bad people also know. And they also start to realize that this thing's in your house, it's on your person, and then digital with AI and stuff. And so it's just it's a whole can of worms. I share it mainly because the goal, or you shouldn't get dissuaded and pessimistic about it. There's solutions out there. You just have to know what you're doing. But that's really the proxy why there's still so much upside, because very few people know this. So if they even get off zero, they're buying very small marginal amounts as it relates to their relative net worth, because they don't want to lose all their money tomorrow.
Yeah, it's like this. Do you think that multi-institutional is obviously you think that's a stupid question of mine.
I'll be objective though. No, I'll be as objective as possible. And
I'm asking because I'm really interested in. I'll quickly get a little bit context to the question. The podcast that I just had before that, which launched probably like 2 days ago for the viewers, was with Bitcoin Katie, and we talked about the internet comparison of Bitcoin and how she thinks how the internet looked in like 1995 is kind of how Bitcoin looks right now. And so looking back at 1995, how the internet was and how messy everything was, like you had to get off the internet because you otherwise couldn't get a phone call in your landline because it was on like one line. And now I was just in India. I had on my phone an eSIM and had access to internet while I was in India for like a week, and it cost me like $30. It was like nothing, and it supplied me with internet of all my trip in India, and it was great. So like it was a very good experience. And so we went from like this landline thing was clunky, bad to set up and all of that, to like it's super easy, quick, and accessible everywhere. And like obviously what has grown out of the internet is fascinating. And so I'm thinking a lot of how much the Bitcoin ecosystem sucks right now and how much better it will be in like 15 years from a custody perspective, of a financial perspective, of applications on top of it, like all of it. How do you look kind of that, especially with the custody setup question in like 10, 20 years?
Yeah, I mean, it's a great question. I think like, and I can go deep, but like the reality is I truly believe we're so early, we haven't figured out custody. And I think that we, as humans, it's hard enough for us to wrap our heads around a new form of money. So to jump from a new form of money to a new form of custody is a big leap. And that's really where it's taken so much time. So the angle I use is, whether it's TradFi or us as Bitcoiners, we've used two-dimensional solutions to a three-dimensional problem. And what that ultimately means is think about how people hold Bitcoin today. It's the same way people held gold thousands of years ago. You can leave it with a centralized third-party custodian, that is your goldsmith or your bank, or you can take delivery. You can just hold more gold in your physical hands in a hardware device, but you still have the same trade-offs, whether it's physical risk. Access to financial services is a great example, because like we work with the hardest core people that if they want to take a mortgage out, we're working on interesting things where you can cross collateralize your BTC, but you can't hold all the Bitcoin if you're going to take like, get some access to dollars to put a down payment, but you don't want to sell those Bitcoin. You have to have it in a construct. And most people understand you don't want to leave it at a third party custodian, because if your mortgage is meant to be 10 to 30 years, no custodians last that long. So think about inheritance as well. IRAs in the US for like retirement accounts. And this continues down from lending. My previous business, Unchained, we were the only lender that never lost a single dollar. We used a similar construct as this. It's very straightforward. It's like 3 is better than 1. You have 3 custodians. You have the technical governance, right? That secures, meaning that each of the custodians are securing one of the keys. But then what really makes this work is legal governance, because at the end of the day, we still live in a rule of law. We still will trust institutions. We just want to strip away the unilateral control of like letting them fail us, because that's where gold failed, is the centralization. So what you're really getting at is the thing that I say is the difference between gold and Bitcoin is literally that you can insert governance at the asset layer, that you can distribute that underlying. And then when you do that, the beauty of Bitcoin in Bitcoin only is that multi-sig is native to the Bitcoin protocol. So there's nothing proprietary here. So it can scale proportionally to whether it's the financial products or amount of assets. So if you're MSTR, you could have a 305. If you're doing an ETF, when it comes to lending, settlement, retirement, loans, like I think everything, and the easy example is something that we'll look to develop is, imagine you have a multi-institution vault. And we'll talk about this offline because it makes a lot of sense for your business, especially with some other things we're doing. But you have a multi-institution vault with $1 million in the loan. And just for like, just to I'll pull it up just in case anybody's like curious, like what are they talking about? Because I think a lot of these things become a little bit like ephemeral until you see it on a screen. But point being is, let's say you have something like this multi-institution that's sitting and holding, let's call it just for easy math, $1 million in your custody. So you have it on-chain verifiable. You can even take out the wallet so you can view it in an open source watch only. But then remember, legally, each of the custodians have to work on your behalf. And you have to produce some kind of video verification with each of 2 custodians. But point being is, so you have your long-term custody, but let's say you need $100,000 for a loan. Well, all you have to do is layer on additional legal agreement that you're saying like 50% loan to value. That's somewhat conservative. If you want to get ultra conservative, 40% loan to value, which would be $250,000. But for easy math, 50% loan to value. So you have $1 million, you need 100,000. You're encumbering. You're saying 200K can never move in this wallet. 800K is free floating. It's all your money, but you took out a loan, so you need to make sure you're padding that with that margin. The other 800,000 is always available. Theoretically, on a long enough time horizon, if you have 800K, you can actually get lower interest because whoever's giving you those dollars knows you have additional collateral, so it's less risky. Then you can take those dollars and park them in a wallet because everything's becoming digitized. So stable coins will be running on the rails of all these banks. You have a card you can spend on, and you can just like manage your financial life with never sending your Bitcoin and lower that cost. Like these are all the things that we will develop and are working on. And it's not to say you don't hold self-custody. It's just that in a world where risk increases, you're going to want people to know you're using something that you cannot move those assets. It takes, either 24 to 48 hours, if not longer, if you set up permissions. Because in the same way people don't rob, again, Mark Zuckerberg or Jeff Bezos, they naturally will not rob you if you have to go through these processes and you're trying not to get caught if you're a bad actor. And then the other side of it is on the digital AI front with deep fakes, with all the craziness on going into wallets online, you're going to want those keys offline and humans to interact with you to verify that it's actually you moving those assets.
That's fascinating. Just because people might be interested in how much does it cost for individuals to do those things with on-ramp?
Yeah, so we've really lowered our cost for as long as somebody has enough of a balance that warrants to pay $250 a month, they can become a client. There's no minimum. And we'll look to even drop that even lower. So somebody on average needs about $100,000 in BTC. But we have some other products coming out in the coming weeks that will even go to lower. There were people want to buy Bitcoin at the lowest cost and some other really cool stuff. But we operate like a private, like global private bank. And our clients come in from $100,000 to, $250 million. But the beauty, and this is like, goes back to the analogy of the MacBook or an iPhone, is it always sticks with me in the election where they were sitting in Mar-a-Lago and Trump and Elon Musk both have an iPhone. But we have iPhones, right? Everyone has access. It's all democratized in the same way that the construct, the multi-institution, it benefits the largest holder in the same way it benefits somebody with $100,000 or $1 million. Like that's the elegance of technology and the ability. And so part of the thing we released this week is that people can just self-onboard. If they never even want to talk to us, they can onboard. And it's really a technological feat. Before, I would have to ship the devices, onboard every person, explain everything. Now the keys are already generated in custodial setups along these regulated custodians. They're offline, they're sharded, they're in banks, all this funny, sophisticated stuff. But the point being is that the APIs are hitting the extended public key. So the vault is being built almost instantaneously while you're onboarding. And then you have these different entities that work on your behalf. And the last thing I'll say is, like, we had this guy that explained it early, is the notion of self-custody being the only thing is like a very bearish take on humanity for two reasons. One is because it doesn't even facilitate any kind of like explanation of how would you coordinate economic activity. Like, how would you just go and finance anything or have banking relationships or need to do anything? It also says that, like, we don't believe we're going to live in a world where we don't trust people to make our food, right? We live in a trust-based world. So if we believe we're going, like, it's just very bearish that if we all don't trust anybody, we have to hold our own money. That means that we're going to be testing our food and everything under the sun. So there will be trusted entities. But the idea of building with Bitcoin's ethos and the fundamentals of inserting governance at the asset is that you have no entity that's a single point of failure to lose your assets, which it's like 10x the security with like 1/10 the friction is ultimately what we do. So yeah.
I love the analogy with the iPhone because it hit me. I was in India, and there the whole, like, if you look at the average salary of an Indian, it's like very different to the average salary of an Austrian or average salary to an American. But they all have the same phones. Somehow we all end up with the same technology. And I can sit next to Seyr and I have like a net worth of nothing compared to his like 12 billion, but we have the same phone, which is such a great equalizer. We work on the same phone, we work on the same MacBook, we have probably the same access or almost the same access to AI, and all this technology is a great equalizer to put everyone on the same playing field. Now, what you do with technology differs. Like Seyr makes a lot of more money with his iPhone than I do with my iPhone. That's for sure. But it equalizes the opportunities that we have with that iPhone. I love that analogy.
You're exactly right. I mean, there's a standardization that we're really after. Like, if you had to come up with what are we or who are we? It's like we're like one part Goldman Sachs and the other part AWS. Because what AWS understood is Amazon was building their infrastructure, and then they understood that they could benefit, but also the world, if you could standardize how to host web services, because you democratize the ability for anybody to build a technology company or just house that, right? Because on-prem and all the things you had to go from an admin and all of that. So the same way you're describing is this is a standardization layer, because once we get into that three-dimensional view of, wait, we can't have a single entity because this is just data and any data can lose the data, you're going to have everyone, it just becomes understood. It's like, I leverage this, and this is how it'll permeate. And like on the other side, we'll look back and again laugh at that we trust a single entity, because the rational thing from anybody is 3 is better than 1. And if all of your assets are at Coinbase and Fidelity, JP Morgan, and Bank of America offer this, well, why would you keep your assets at Coinbase? Right? Because you mentioned earlier, like, if they have the losses, there's no balance sheet, there's no equity value, there's no bailouts in Bitcoin. So again, nobody talks about it because very few people have relative amounts of Bitcoin. The people that do have material balances have them in cold storage, but they're also feeling the pain because no access to financial services, the risk, all the things that we talked about. So that's that angle of like, once you can democratize and standardize in the same way an iPhone, then the market just understands that you don't need everyone too. Like it's the same thing with Bitcoin will hit a certain drift once you get to 3 to 5% total market penetration, and everyone just understands Bitcoin's the best money. In the same way, once you get a standardization of major custodians that offer this, then everyone else is like, I only go to that, and you don't even have to explain all of these things. We're just that early in the process.
I just realized we are over our time. I hope I don't hold you from any meetings.
No, we're good.
Okay, perfect. Because I there's one more topic that I asked you before the episode. What is currently most dominant in your mind? I think you said AI and Bitcoin, and I haven't even asked you about that thing. So maybe just briefly, what is for you the essence between the AI and Bitcoin connection that is so fascinating?
Yeah, so we'll make it tight. I mean, there's a lot to go, and maybe we'll do it again. But at the end of the day, it's just rational as AI proliferates and the speed. Everyone has their own sense of like how fast it's going, right? Most people are probably on both sides of the barbell. People aren't paying attention, or people are thinking that it ends the world, and it's probably somewhere in the middle. But the rational thought, when you play around with this stuff, when you start linking up, whether it's your models to other APIs, or you start having some of these other things like Clawbot start to just like spread out and link into other APIs, there's still an insane amount of clunkiness around the onboarding experience to the platform, but then also how do you pay? Because you have to effectively get these cards and give it credits. And so you can just squint and see how it'll be ubiquitous that a digital form of money at micropayments will just like, kind of flourish online. But this ties into that we'll see stablecoins do this first, like full stop. Right? Like we'll be on the fringes with certain applications. In the same way, I think it's like a soap miner or whatever, like you can only buy their soap via Bitcoin. Like, yes, you'll get some applications online that will only accept Bitcoin. But for the vast majority of people, they're going to accept stable coins. Like Coinbase just launched yesterday a wallet for like agentic wallets for AI. And then there's, I forget who, I think it's Stripe, did like 402, effectively creating like plumbing so you can power these stablecoin models, these models via stablecoin. So you can pay for the usage effectively because it has streaming capabilities and all the things that you naturally wouldn't have if you had to go like right now, if you go to Claude and you want to get their API, you got to put in $100 credit and it's just clunky. But the thing that most people discount is stablecoins are very bullish for Bitcoin, because in the same way, stablecoins are going to show most people that money is digital and can move. And it gets people from fiat to a digital form, because a stablecoin to Bitcoin conversion can happen pretty instantaneously, effectively, in the same way that stablecoins online. And so there's just this notion of, like, I've always thought this, you're going to have a convergence effectively of digital technology needing Bitcoin, and it's going to become more and more ubiquitous, and people will just have a wallet that'll have dollars, but that'll be powering some of the things that they need in an AI world. And then on the other side of it, you're going to have the store of value in savings, and those things won't be one or the other. People will just come at it from their own respects, and they'll just like converge as the price is moving, drifting up.
That's super interesting. I love the intersection there, because if I wouldn't had an Bitcoin podcast, it might just be an AI podcast.
Yeah,
it's very fascinating, but I like Bitcoin more. That's I come back to that always, but it's a very, very fascinating one. We have an end routine, as you might know from last time, where the previous guest is asking a question for the next guest without knowing who the next guest actually is. And the previous guest asked you the question. It's a long one. Do you think the passive investing boom of recent decades, like ETFs and funds and stuff like that, and subsequent concentrating in the tech sector, has created systemic risk that Bitcoin could serve as a hedge against? So basically, is passive investing kind of making zombie companies and making systemic risks to the financial system?
definitely. Yeah. I mean, I think that's basically the whole adage of too much debt and not enough dollars. We may have talked about on a previous business or for podcast, our version of our venture fund early riders is Bitcoin denominated. It's with this understanding that too much debt, too much capital that gets inserted, whether it's somebody on a venture side or what you're talking about in the public markets, just distorts all economic coordination, efficiency. And so you have these companies that are zombie companies. And when you see deflation like AI, where people can build those companies 10 times faster with 1/10 or 1/100th of the cost, it's going to completely cause insane disruption. Because think about if you were working at a large firm that had a bunch of debt, a bunch of headcount, and you knew everything you knew about AI and you left and you started the business knowing what you know now with using SaaS, using AI, and like digital marketing content, where these companies don't have really good lens on how to like win customer acquisition, or the customer acquisition cost is like 10 to 100x what it should be because they're not savvy on how do you actually win. That becomes very disruptive because you also can lower your costs because you have theoretical less capital outlay and less business, like less cost that you have to account for because you started very nimble. And so you just like completely collapse. Greatest example is like DeepSeek and the open source models that they've been releasing versus the frontier models, and how you don't necessarily have to even pay OpenAI. There's billions and hundreds of billions of dollars that have been allocated, and a lot of it's debt. And you don't even necessarily need that. You can just go and download a frontier model, buy a Mac Mini or whatever you need, depending on the amount of RAM, and you can run that locally. That's a microcosm, but like that translates throughout the whole society. So yeah, there's going to be a lot of repricing, and then ideally like there's some softening. I think that's where like bit bonds and other things where Bitcoin gets infused, but yeah, it's going to be very chaotic. The last thing I'll say is that ties into the counterparty risk, where do you park your capital if that's a world where it's going to be happening? Because a lot of people don't underwrite. There's air pockets in the global economy where you may think you're holding, X amount of capital, and it could be, not even marked subpar, like at zero. Because if the investment fund, loses that capital, it goes under, declares bankruptcy, you get $0 on your money.
It's so fascinating because there's so many different levels and perspective on like how Bitcoin will change parts or change the perception of the world, and therefore also change how things will be working. Just the whole podcast already touched on like multiple of those factors. So thank you so much, Michael, for being on. Before I let you go, where can people find you personally, but also on Ramp?
Yeah, on Twitter, Tanguma. Shoot me a DM if any of this was interesting or you want any kind of like research or stuff we've done. And then our website, onrampbitcoin.com. You can book a consultation or just shoot me an email, and happy to answer any questions.
Really cool. Thank you so much, Michael, for being on. And also thank you so much for everyone that is watching and listening, for joining us today. As always, I'll be back. This content is for educational and entertainment purposes only and does not constitute financial advice.